Okay, everybody. So I've actually asked Joe over lunch what did he say behind my back, and he said that he says that I'm a pretty movie star. Is that correct? Hey, how come Vivian is? Hey, how come Vivian like laugh until like it's not correct or not? Is it what he said? Yes or no? Can you tell me? Yes or no?
Okay, pretty, pretty.
Wow, you see so many people helping you. You see, you see now I know who are my true friends. You see, Jerica says no.
Jerica, now I know who are my
Gavin,
friends.
Gavin says no. Listen to the record. Okay.
I know who are my friends
Now I know
now.
who is on my side, who is on Joe's side. You all are very bad. Okay, so later on I will go and question you some more after this whole thing. Okay. Alright, okay, so we're still letting some people come in. Okay. I just want to comment on your homework. I really think that is very, very well done. Hey, Brad Pitt, what do you mean, Brad Pitt? Okay, he said it's good to dream. Oh yeah, Bernie, yeah, the guys are backing up Joe, so girls, you must help me. Okay, so okay, I just want to comment on the homework. I think it's very well done. Okay, I really love how you all are actually thinking deeper about the valuation methods that are being used. Okay, so I just want to open up. Okay. Okay, so like for example, Bookyong, okay, I think it's very good that you have started to use things like, okay, I will not consider valuation based on dividend because they're too far out. And I love how you're actually apply what you think is appropriate for the stock. Okay, so like for example, for him, he has applied the EMAs as well as the PE valuation. Okay, so that's very good. Different stocks, different play. Can you all type that in? Different stocks, different play. Different stocks, different play. Okay, different stocks, different play. Okay. Yeah, okay, so for for Kwok Liang, okay, so he says that all the valuation shows very low pricing versus the PE valuation, so need to do more studies. Okay, so actually what has happened for Kwok Liang's case, right, is that, is this a good or bad scenario that, okay, you see all his prices, right, is actually under the undervalued range. Is this a good or bad thing? What do you all think? All his prices are actually under the... Okay, so actually to me, you see right now, right? Okay, I don't know whether you all can see this because all these are quite small. Okay, so his undervalued PE valuation is 76.35. Okay, then you can see that actually the stock price currently is already within the fair to undervalued. Okay, so actually as of now, right, $91 is in between the undervalued and fair value. Can he enter now? Not? Yes or no? What do you all think? Okay, so actually right now, yes, okay, he's actually already entering based on a very good valuation or fair valuation. Okay, so the technical prices, like for example, he has one at $70. Okay, this will then give him a better entry opportunity. Okay, so if if you're here, actually right now you can already enter because it's within your PE valuation range. Okay, then the 70 and the 45, 60 and all that, right, $23. Okay, all these are better entry opportunities for you. Okay, so it's very good when you all do homework in your post. Okay, we can actually comment on all these. Okay, okay, so I also love what David said. Okay, calculation based on PB, dividend, and PG way off. So he's sticking to valuation based on PE. Okay, so you can see actually in the end, right, the very reliable valuation, right, in the end is which one? What do you all think? In the end, it goes back to which one? Yeah, in the end, it goes back to the PE, right? In the end, it goes back to the PE. So that's why it was covered on the first day. So actually, at the end of these 2 days, okay, if let's say really everything is very overwhelming, okay, just go back to fried and PE. Fried and PE, that's it, okay? Fried PE, that you're already good to go. So all the other valuations and all the technical analysis is just to give you better entry opportunities, okay? Okay. Yeah, so okay, thanks Wesley for also answering to Bernie's question on where to get the EMA. Okay, so all right, so okay, using traditional PE doesn't make sense if using EMA. Okay, so let's take a look at PayPal. Okay, PayPal is quite interesting because the stock has actually shot up by quite a lot okay, recently. Okay, and even it has shot up so much that even based on PE, right, okay, it is still, the current stock price is still too far from the current PE. Okay, so in this case, right, what he has decided to do is because is he would actually use entry based on the EMAs. Can we do that actually? Yes or no? What do you all think? Can you do that? Yes or no? Okay. Right. Okay. So so you can actually do that based on EMAs, because at least, right, you are actually entering based on the price history. Okay. But I would say that you can also still keep to your PE valuations. Like for example, you can still keep 46 as your entry points and 35 as your entry point. But in addition to those, you can also consider your EMAs as your entry points. Okay. So this is, for example, for a stock, right, that has actually shot up very, very fast. Okay, in the recent days lah. Okay, but also you realize that PayPal is actually forming a top or bottom now. Can you tell me, is it forming a T or B now? T or B? Okay, it's forming a top now. So we want to wait for it to come down to the bottom. And when it comes down to the bottom, it's likely to hit either one of the EMAs. And even better still, if it actually hits the 46 range, right, that would be best lah. But currently, the PE valuation seems a bit unrealistic. So our first entry may have to be based on the EMAs. All right. Okay. Junjie, are you ready? Actually, Junjie, if you're ready, can you say yes? Okay. The reason why, okay, Junjie is actually ready. Okay. So, okay, later on we will actually also go through WFC, because quite a number of you have done on WFC as well. Okay. Then we have Nita's question on BAC as well. Okay. So, Junjie, can you actually unmute yourself and okay, let me stop share first. Okay, Junjie, can you unmute yourself and let us know what stock you are actually doing on?
Can you hear me?
Yes, I can hear you.
I'm doing Merck.
Okay, Merck. Okay. Okay, how many of you have actually heard of this stock, Merck? Can you all type yes? Okay, so honestly, I have never heard of this stock before. Joe, have you heard of it before?
No.
No, okay, but many of you have heard it before. So it's good. Okay, so we bring this up for discussion so that, pharma is a pharmaceutical company, is it? Okay, very good. Okay, so okay, Nicholas, you heard of it, but don't know what they do. Okay, so maybe, it's from spiking. Okay, so, holy moly. Okay, so I mean, since we have actually all heard about this stock, I mean, you all have heard of this stock, you should be quite curious about it. Okay, so I was thinking, maybe it would be a good time to actually apply whatever you have learned over the 2 days to see, if for those people who want to enter, is it actually a good company to enter? And if let's say you want to enter, what would be a good valuation? All right. Okay, so Junjie, I hand it over to you.
Okay, let me share my screen first.
Okay, can.
Let's try. I'm trying it for the first time. Hang on.
Okay, can.
Are you all looking at the 10K report?
Yes, I am. Yes.
Okay, for me, I just quickly go through the business model of Merck lah. As what everybody know, it's a pharmaceutical company. So we all know it produces drugs, vaccines, and all the veterinary vaccination also. So that's the key part of pharmaceutical business. I think, yes, for me, I also got this idea from the spiking also lah, to be fair to everybody.
Okay, it's good. I mean, you can actually get stock ideas, but it's good that now you're doing your research on it. Okay, which is a level up.
So, okay, if we now go back to the fright analysis, let me see. If I change to Excel, you all won't see the Excel, right?
Okay.
You're still looking at the 10K, right?
When you share screen, right, you can share your desktop. Then whatever you can see. Yeah.
Okay, let me try. Okay. Is this better?
You can see already. Yay. Okay.
Okay. So the current share price of Merck is at 76.3. I will just go one by one into the fright first.
Okay, can, sure.
Okay. The free cash flow, I give it a 2 because from the Morningstar, let me take out the Morningstar first. Take out the Morningstar. The free cash flow, it is increasing and it is positive. So we give it a 2, or at least I give it a 2. Okay, next one. For the ROE, I give it a 2 point also, because from the Morningstar is at 37.76. For the interest coverage, right at the bottom is more than 10. So I'm giving it a 2 also.
Yeah.
Okay, then for the EPS, 1 point for positive and consistent, 2 point for increasing. Okay, now if I look at the EPS, for the whole range, right, you will see that it's not a very linear way of going up. There's like small ups, small downs, and some heavy up and heavy downs. So actually, I discount the increasing. I just keep it at a 1.
Okay, I think that's a conservative way of doing that.
Yeah. So for the dividends, yes, they do give dividends. And the last one would be the debt equity ratio, 0.83. I give it a 0 because based on this analysis, it has to be less than 0.5. But typically for pharmaceuticals, the debt equity is normally slightly higher because they need a lot of funding for R&D. So they have always, this industry always like request for funding from external parties.
Okay.
But nevertheless, we look at just price. I just give it a 0. Anyway, the whole idea is to be conservative. If it gives him a reason to say that I'm not confident of this particular ratio, I'll just bring it down to bring down the business confidence. Okay, then I go into the risk.
Okay, showing your free cash flow again. I think Victor is asking whether is the free cash flow consistent and increasing.
Oh, okay. Let me go back to Morningstar. The free cash flow is here.
Okay, so for you, you feel that it is positive and increasing lah. Okay, so I think some people. Okay, so it really depends on your own risk profile lah. Okay, so for example, Junjie, you have actually given a 2, right? That means for you,
Yep.
that is increasing.
Yes.
Okay, so for some people here, they think that, okay, it should be 1. So if you feel more comfortable with a 1, you can give a 1. So the impact that you will have will be on your portfolio allocation. Okay?
Yes.
Yeah. Okay, and then Pete is actually commenting on the earning. Can we look up at the earnings? Can you scroll up to the earnings? Okay, we see that, actually previous year's earnings have jumped quite a lot, 3.81 and 3.95, right?
Yeah.
Yeah, so I think one interesting thing to actually take note of is actually what actually caused the previous year's earnings to be so high? Is it likely to be a one-off thing, or is it likely to be a consistent thing? Correct? Because eventually this will impact our PE valuation as well, right?
Agree.
Alright,
And probably there's a question at the back that I have also lah.
Okay, so later on when we go into that, we can actually discuss more together as a community lah. That's the power of it. Yeah.
Yeah.
Okay.
I purposely find a very up and down stock lah, up and down valuation stock. Yeah. Okay, so I go back into the risk factors. Okay, pharmaceutical, even without looking at any annual reports, right? The risk is actually very high. So without looking at it, it's already a -1.
Yeah, because they consistently have to do R&D. If not, they cannot come up with new products also.
Yeah. So inferior net margin, I give it a -1 because on the right, I compare with Pfizer and Lilly. They're actually the lowest, so I just give it a -1 here as well.
Yeah.
Okay.
Then authority. This industry also very heavily regulated by the FDA. So whatever they do, they have to be very compliant. If not, if they do something wrong, right, that's it. So also without looking at the report, industry as a general, I would just give it a -1 really.
Okay, so it sounds like pharmaceutical companies is within your circle of competence.
Half lah.
Okay, but not too bad. I mean, at least you're able to analyze all these. Okay, good.
Then for key person risk, this industry also typically says that if this person resigns and join another competitor, right, they normally have to sign a NDA. So they cannot say that, from company A, whatever I learn, whatever I do, I go to company B, I can just disclose everything. I normally have a time frame that I cannot reveal anything I do in company A. So by then, right, the technology or the knowledge I know would have gone obsolete in company B. So that is the sort of like patent protection for your previous company. So the risk for this industry, right, is also a bit subjective. Some people may want to put -1 if you think that if you think that the knowledge, if the person jumps ship, right, would pose a risk lah. But for me, if you have the NDA protecting you, it could be a zero also.
Yeah, true. Because by the time because they are protected by the law, right? So actually, even if let's say your key person moves over to the other company, you cannot really reveal the company's secrets lah, in a way.
Correct.
Yeah.
So the previous company actually can sue for damages also lah. Yeah, I mean if it goes into all the legal proceedings. Okay, so I move on to the mode. Okay, for the mode, an intangible asset, if I look at the balance sheet, let me just bring it up also. Hang on. Balance sheet. Oh, sorry. Okay, balance sheet. This is the valuation. Okay, let me go back to the code. The valuation is the balance sheet. Sorry, it's the financials.
Yeah.
Okay, balance sheet. Intangible assets. Okay, I just look over to the right. So there is a intangible asset lah, which actually this industry is heavily reliant on, because they need to build up the brand to say that, hey, my vaccination, my medication is actually well accepted by the public or well accepted by the institutional players.
Yeah.
Okay, next one. Let me have a look. Low cost advantage. So based on the analysis, we have to compare with the operating margin. Again, I compare with Pfizer and Lilly. The three of them looks to be similar at this point in time. So as far as the confidence level goes, I can give it a 1.
Okay.
Yeah, of course, now it's just the mid of 2020. So the low cost advantage for this one is also subjective to changes every quarter or every year when you review this stock again.
Yeah, actually, in fact, everything lah, almost everything, every quarter you have to update this lah. Yeah.
Yeah, makes sense. Thanks.
Yeah.
High switching costs. High switching costs for pharmaceutical, because they are protected by patent rights. I think if I use a very generic analogy, is if you are using one particular brand or medication, you probably want to stick with it for a very long period, because you wouldn't know that if another brand is it suitable for you or not. In this case, in this case, there's also another issue of the copying, imitation. Even if you stick with one brand, if a low-cost brand generic item comes up, two trains of thoughts. You may want to switch, you may not want to switch. But if you want to be very thrifty, if you're a very thrifty spender, a thrifty person, right, you will likely switch to a low-cost brand. Because pharmaceutical is actually it relies so heavily on R&D that another person, if you have the R&D capabilities, you can catch up very fast.
Yeah.
Then for the network effect, going back to what Pete shared earlier, this industry, the main suppliers is actually the manufacturers and actually the R&D itself. So you don't actually see the impact to the general public customers. So I wouldn't give it a point here.
Okay.
Then for the efficient scale, the barrier entry is actually it's also subjective. It can be high, it can be low. For me, it's very low because of the speed of imitation. So actually, new companies can actually come up very fast if they happen to have the capabilities.
Yeah. Okay, so Kelly is actually commenting on the switching costs. Okay, she mentioned about doctors deciding to use the brand of medicine. So actually, in a way, consumers wouldn't really have the option. Okay, that's actually true. So also depends on, because I haven't really studied in this company, whether the kind of drugs that they are producing, is it over the counter? Are you able to purchase it over the counter, or like Panadol, for example, or is it something that the doctors actually prescribe to you lah? Because if the doctors prescribe to you, then the question is, do the doctors have a high switching cost, for example? Yeah.
It goes both ways, because Merck has specialized medication. It also has the OTC medication.
Oh, I see.
Yeah. So it really, like you said, if different doctors carry different brands, so the switching cost in this case sometimes is dependent on who is the customer that you're referring to in this case.
Yeah. And anyway, as far as possible, if let's say we want to be conservative, we can always give it a 0 lah, which is what you have done lah. So if it's not very clear, the switching cost is not very clear that there's a high switching cost, we can give it a 0. Yeah.
So with the fundamentals, we have gotten a 7.5, but because there's so many subjective factors in the pharmaceutical, I've actually lowered down to 7. Personally, lowered down to 7, so I keep it at 7%.
Okay, so your portfolio allocation is 7%.
Yep.
Okay. Have you put it down in your overview already for your portfolio?
Yeah, I did. Let me just show you.
Okay, if you don't mind showing us. Okay, so you're
Yep.
starting with eventually your portfolio you want a 70K lah, right? Or
Yeah. Sorry.
Eventually you are going to have 70K as your starting capital lah, right? For your portfolio.
Yes.
Okay.
Yes.
Good. Okay. So based on that, you have given a 7% allocation, and that's $4,900 lah. Okay, so later on we can go through what you can do with this $4,900.
Okay.
Yeah.
So I will move on to the valuation portion.
Okay, I think before that, let's take a look at some of the comments.
Yeah.
Okay, if Merck has debt, would share buyback be sound? Okay, so just now you mentioned, right, that the debt to equity is actually a bit high, but that's quite typical of pharmaceutical companies, right? Any idea, when you read the annual reports, any idea whether there were share buybacks?
There is. I think I missed that. Oh, I missed the others. The
other three. Okay, we want to go through the other three first? Yeah.
Yeah. Sorry. My bad.
It's okay.
Hang on.
Yeah, doing very well. Okay. Yeah.
The increasing revenue, I think let's go back to the profitability. I think this one is quite clear cut lah. Quite clear cut. It's increasing lah.
Okay.
But if you look at the whole 10-year trend, it will seem to be somewhat consistent with drops in the middle of 2013 to all the way to 2017, but it has climbed back up slightly in the last couple of years. So this year will actually be a year where we see is there a increase or not, because I think of the COVID situation, so many eyes will be looking at the whole vaccination industry.
Okay, so personally for yourself, you've given a 1 or 2?
I give a 2.
You gave a 2 lah, even though the increase is not really a very obvious increase lah.
Yeah.
Okay.
I just compare it with the last 2 years, because of course if you look too far back, it gives a trend, but it can be, the situation of 10 years ago and now could be much different. Okay. So it may not be so applicable.
Okay, very good. I like how you're actually developing your own thinking process about all these companies. That's very good.
Okay, next one we go to retained earnings. Retained earnings, let's see. Retained earnings will be in the balance sheet all the way down. Okay, retained earnings. Here you go. There is a retained earnings from the after taking off the liabilities.
Okay, good.
So I gave it a 2 also.
Okay, great.
Yeah. The share repurchase, I think, which to answer that question, let me bring up the report. That's the report. Okay, let me just do this. Okay, let me look at the previous search. Okay, it's just very recent only. They have announced that they have increased to the quarterly dividend, and also the return 10.5 billion to shareholders through dividend and shares repurchases. So if I move on to the next search criteria, they say that they have cash used in financing activities is just very recent, 2019 compared to 2021, which was slightly lower, but they have a accelerated share repurchase program in 2018. So they are actually buying back common stock. Let me see if I can show this part. I happened to saw the repurchase of common stock, but I think let's just not go into too deep here first. Let's just focus on the key points. So the the remaining share purchase authorization was 7.2 billion. The remaining, we're not talking about new authorization, we're talking about remaining. So that is still quite a hefty sum to go. The previous year's purchase was 9.1 and 4 billion. So you realize that actually there's almost, if you add simple math on it, there's about 50 more, slightly to 50% more to go.
Yep.
Yeah. So that I give it a 1 point here lah.
Okay, so to you, even though it actually failed your debt to equity point, but you still find it valuable that the company purchased back their own shares lah.
Because from my personal point of view, share repurchase means if you look at it in a nice way, they want to create value for shareholders. But the other way of looking at it is if you buy back the stock, like what Joe said, if you want to manipulate the EPS to make the financial figures look good, the other way of saying is if you buy back, you need to actually increase your revenue or increase your growth so that the board itself, right, when they do the buyback, they actually can earn more money if they're holding on to the stock.
Yeah.
Very good.
Very good, very good. Okay, so like what Gordon has also pointed out, right? Okay, over here, I think we can feel quite safe about their share repurchase because they also have very high cash flow. And at the same time, we also see that they have a good retained earnings. And also they have shown in their report that this amount for share repurchase was already set aside from some time ago. It's not like suddenly they want to manipulate the figures, therefore they do a share repurchase, right? Okay, and to confirm this once more, right, can we just go to Morningstar and see whether how much of the EPS is sort of manipulated by this share repurchase?
Okay, hang on. I think while I'm navigating, one part I remember was they actually had a stock purchase option for the management. So it means to say that you can't be just doing stock repurchase and not increasing value for the management. It just doesn't make sense if you just purely come from a EPS manipulation point of view.
Yeah. Okay, so we can see that the shares has actually did go down a little bit. Okay.
Yep.
So that the EPS has also gone up. Yeah. Okay, but then we can be assured that that actually is not really a manipulation because of the other factors. Like for example, the company had already set aside this amount of money for share repurchase anyway. Okay, they also have good cash flow and they also have good retained earnings. Yeah. Okay, so by the way, right, we actually asking all of you to present your homework because this is the kind of standard we expect you to have when you do your coaching calls. That means from now on, right, after this 2 days course, the level of quality of your coaching course should increase, correct or not? If you all agree with me, type yes, please. Of course, it is true. Okay,
yeah.
I mean, to be very honest here, all of you paid quite a huge sum of money to come into the OMM, right? I mean, you paid quite a huge sum of money, so of course we want to make your money worth it, right? And if you level up your coaching calls, if you level up the quality of your questions during the coaching calls, then you'll get more value, right? At the end of the day, we also value the money that you put into this OMM team and we want to give you value, right? If you all think this is valuable, can you type value? Okay, so in future, right, all your coaching calls, regardless of which mentor you choose, okay, we're going to let the mentors know that from now on, this is going to be the standard of your coaching calls. Can or not? Do you all agree now? If you all agree, type agree. Okay, very good. Okay, so Pete, you're here, Pete. Okay, some people scared. We say I joined in April.
Go laugh until like that.
Okay, very good, very good. Okay, so anyway, and you can see that it is definitely possible. I mean, if for the coaching course, if let's say you cannot go to so much detail like Junjie today, you want at least do the FRIED and PE valuation, can or not? At least FRIED and PE valuation, can or not? Yes or no? Can, right? Okay, and then if let's say you can be a bit more advanced, you can do the FRIED SNCC. And if you can be even more advanced, like for example, Junjie over here, you can do an even more detailed analysis. Remember, okay, that we respond according to your level. If you yourself can level up, then we can give you even more value during your coaching calls. All right, yeah, very good. Yeah, you're doing value investing on ourselves. Very good. Yes, you're doing value investing on ourselves. I like that analogy. Okay, very good. Okay, yes. Junjie, please continue. Thank you very much for your FRIED SNCC analysis. And you are going to allocate 7% to your portfolio. Right, that's very good.
Right. Yes. Okay, then I'll go into the valuation portion. for the PE ratio, what they give for the current year is 19.29. The 5-year average is 41.35. That already tells me that I need to look backwards at the trend already because it's just too big a gap.
Okay, but currently now, so that means you won't straight away say it's undervalued already lah. You will go and look back first lah.
Correct. So let me just bring up the MERX. Okay, where is the
Okay, so
valuation?
while you're bringing this up, I'm going to ask Joe a question. Okay, Joe, so Ming Chun is asking, right, if let's say PEG, okay, because sometimes it could be possible, right, that Morningstar don't have the PEG ratio. Is there a manual way to calculate the PEG entry?
Can.
Actually, it's basically earnings times growth, right?
Earnings divided by growth.
Earnings divided by, really meh?
Yeah lah, if not how to be less than 1.
No, I mean, not PEG ratio, the entry price.
PEG,
I think it's earnings times growth, you know. Okay, never mind. Let's take this offline first, then we will update you. Yeah, it should be earnings times growth, right?
Price is earning times growth.
Yeah, price is earnings times growth. Okay, so to answer Ming Chun's question, so let's say, for example, the PEG ratio on Morningstar, sometimes it doesn't show up. Then how do you get the entry price based on PEG? Very simply, okay, do your maths. Price divided by earnings and growth is less than 1, right? So if you bring the earnings and growth from the denominator, bring across, your price is actually equals to earnings times growth lah.
Wow,
okay?
maths teacher.
Yay, I'm a maths teacher. Yes. Okay. Okay, very good. So all of you are learning how to be nimble investors. Okay, yeah, Jun Jie, you got your page already,
Mm-mm.
Please continue.
So if what I was saying just now, the current PE and the 5-year average PE is already such a big difference. So when I look back at the trend, I'll just scroll slowly. Let's just have a look. Take note of the 2017 and 2018 figures.
Okay.
You see it's 54 and 61.
Yeah.
But if you look back at the trend, it's hovering max about 30-ish to between 10 plus to 30-ish only. You don't see that spike in 2017, 2018, except for the 2010. So for me, when I see this 2010, which is something is so far off, I wouldn't even want to take this P into consideration already. And moreover, it's in 2010, 10 years ago. So forget about it.
Okay, good.
Okay, so if I go back to my Excel, so for the undervalued PE, right, I took the lower end of the smaller PEs. Just want to gauge what is the undervalued price if I base it on the current EPS. So I got 17, which I just do a simple average on it. So I took the figures like 18.95, I took 14, I took and the 19 here. So I just took the middle figure.
Okay, so you took the average of all the low PE values lah, right?
Correct.
If you
Yes.
agree with this method, can you all type agree? Taking the average of all the low PE values to get the undervalued. Okay, that's actually very valuable. Yeah, we can actually do that as well. That's very good. That's being nimble. That's very good. Okay, so based on that, you got undervalued number 17 lah, right?
Yeah. I didn't take the specific figures, I just take the estimated 17.
Very good, very good.
Then for the fair adjusted value, if based on yesterday's demonstration, we normally will just take the 5 average and put it here. Of course, it's really dependent on how far away are you from the current P ratio. But if I look at 41.35, I look at the past year's figures, I don't see anything above 40 except for 2017 and 2018. So I suspect that the 5-year average here has been already been distorted by these two figures, the 2017 and 2018. That's why it shot up to 41.35. So I for this, since I cannot get a very accurate count, I just discount it all the way to 30.
How do you get
for simple calculation? I just take the 41.35, right? I just take the value of 17. I just simply double it. I simply just double it only. Yeah, it's simple. I didn't go for exact calculation. I go for very like a more of a simple gauge only. But of course, this one can be readjusted along the way.
Okay, so maybe can we take a look at your PE history again?
Oh, can.
Yeah.
Hang on.
Okay, so maybe we can ask the community lah, right? Because I mean, all of us are learning together, and anyway, we are setting the standard for your coaching course, right? So it's good to learn together. Okay, So what do you all think? What would be a good way to gauge the 5-year average? Okay, so for Jun Jie, he actually just did a doubling of the undervalued to get 30 lah. So what do you all think? How would you all get the 5-year average or the fair value? Okay, okay, so Ryan says we can maybe refer to the index. Okay, but I think yesterday Joe mentioned that it's not very accurate lah to use the index. Okay, use the other 5 average and get the average figure. So, but then you exclude the outliers like 54 and 61. Okay, some say median, some say subjective. Okay. Average over 10 and take out the outliers. Okay, so Junjie, what do you think? Based on all their, I think based on their recommendations or their suggestions, is actually to include the exclude the outliers. That means exclude the 54 and 61, and then you can then maybe take the 2019 figure, the 2016, 2015, and then you scroll to the left. Yeah, would it be possible to actually, what do you think? Do you think it's possible to just take out the 2 outliers and then divide it by the number of years?
Possible, that's one way. Probably it will give me a more specific figure.
More specific figure. Okay, maybe let's just do it now. I mean, since we are all already at it. So that means we take 1895, correct? Start from 1895. Okay.
What's the 2011? 2011 was 27.52.
Okay, 27.52 lah, okay? Plus 18.95. Okay, plus 33.59. Okay, plus 30.86. Okay, plus 14.2. Plus 30.04. Okay, we are not going to take the 54.11, right? Okay. So can you scroll to the right? Okay, so plus the 25.41 plus 19.32. Okay, so that's how many years? I think altogether I have 8. Divide by 8. Thank you, Gordon. Okay, divide by 8. Okay, A, you know what's the value, Junjie? It's actually quite close to your 30. Is
25.03.
Okay, let's see what they get. How come I got 27.3? That's so funny. What do you all get? Okay, Wei Yang got 25. What do you get, Junjie?
I get 25.
Okay, so maybe my math is so good after all. Okay, so let's use your figure 25 lah. Would you agree with 25, Junjie?
Can.
Can, right? Okay, so very good. You see, everybody's helping you to improve on your valuation.
Can.
Okay,
it's good.
Okay, maybe we change your fair value to 25. Oh, I added a 5-year average, that's why. Okay. All right. Okay, so let's change it to 25. Okay. So how about the over value? Okay, so you're calculating now, is it?
Yeah. Just change it
okay?
first.
Change it first, Okay, 99 point, or maybe 99. Wow, okay, 99 point something lah. Okay, overvalued. Okay, let's see the overvalued. So you took 41 . Okay, for Steve, can we use the competitor's 5-year average PE as a benchmark to see if our adjusted PE makes sense? Okay, I think you can use that as a possible point of reference, but do bear in mind that actually can. What do you think? Actually can, right? As a point of reference. You can. You can use it as a point of reference. Okay, but also like what Pauline mentioned, provided that their market cap and all that is similar lah. Okay. Okay, so Junjie, so you have taken 41 to be the overvalue lah.
Yes.
Okay, so now let's take a look at the EPS that you used. You used 3.96, right? Okay, can we take a look at the Morningstar again? The part on the earnings per share. Okay. So maybe you can ask the community. Okay, what do you all think? Do you all think that it's okay to use 3.95? Yes or no? What do you all think? Do you all think it's okay to use 3.95? Yes or no? Okay. I think the community thinks that 3.95 is a bit big. What do you think, Junjie?
It's only one there's only one 4.07 that's higher than 3.95. So the committee is also makes sense that it is a bit on the high side for the 3.95.
Right? Which means that your valuation, all these will end up becoming very high. Yeah. So
correct.
So what do you think? Do you want to stick with 3.95 or you want to actually take their suggestion to take an average?
We can go for an average.
Okay, so I think like what Ming Chun say, right? I think it depends on what is causing this 3.95. Is it possible that this 3.95 is a one-off thing? I think again, it goes back to, is this 3.95 a one-off kind of earnings, or is it likely to be sustainable? Are they likely to sustain it to be 3.95, or maybe in the 3 to 4 range lah? So what do you think, Jun Jie?
I think that's where the 10K will come in now. If you need to look at the details, because I ran through the business model a bit. There's actually quite a few release of the drugs in 2019. So we don't have any further information on the 2020 yet. Of course, there is some FUDA coming up. The earnings period is coming on end of July. So this will become a key change factor to the quarter EPS also.
Okay, so I think the community is suggesting that so last year's revenue went up by 13%, so the increase looks reasonable. But I think some of the community is also saying maybe we should consider taking the average lah, because sometimes right, some years the earnings are also very low. So as a pharma company, I think I'm not sure whether they are able to keep up to always being able to release new drugs every year, because like what you mentioned, it really depends on their research, and that is actually the risk of pharmaceutical companies lah. Right?
Yes.
Okay, so what do you think? Do you think that we should actually take the average, or?
We can take the average.
Okay, so take the average of the 10 years lah, from 2010 onwards lah.
Oh, 2010. We just take everything lah.
Everything lah. Okay, so maybe everybody can try to calculate lah. So 3.28. Okay.
I got 2.37.
Okay, I think it's divided by 11 because the TTM is also one figure that you took, right?
Oh, yeah.
Yeah, so divide by 11.
Then,
okay, so Booking got 2.15, you got 2.16. Okay, pretty close. Okay, so let's use 2.16 lah.
Okay, hang on. So we just change it to 2.16. So 17.
Okay, I think maybe you can keep your current values. You can just maybe add one more row below so that we can see the comparison lah. So the 62, that one is all based on the current EPS, right? Because Joyce is also asking, if the revenue has increased substantially, is it okay to keep to current EPS? Okay, so so while you are keying those things in, right, I just answered Joyce. So Joyce, it actually goes back to your understanding of the business. Okay, even though the revenue has increased substantially for this current quarter, again, it depends. Do you believe that the revenue can continue to increase at this kind of rate, okay, for the next few years? Okay, if let's say you're not very confident, then the conservative way to do it would be to take the average of the EPS, which is what we are doing right now lah. Okay, so you have actually calculated, yeah, so far, wow. Okay, all right.
Yep,
so right now we have actually a lowered valuation. So under value will be $36, fair value will be 54, over value is 88. Okay, you can copy and paste to Excel to get your average. Oh yeah, that's true. Okay, so Jun Jie, which one will you use actually for your PE? Would you use the 3.95 data, or would you use the average data?
The community average, the 2.16, will be
okay, good.
A more realistic one.
Okay, good. Okay, so based on this, let's go to your TA lah. You did some TA analysis, right?
Yeah. But my TA will be all on the old valuation lah. So pardon me if the chart now look a bit off lah.
Okay. Okay, I'm just going to type it in 36, 54, right? 36 and 54, right? Okay.
36, 54, and 88.
88, 4, 5, 6. Okay, so okay, everybody just don't type anything first. We just leave this here so that we can make reference to it while Jun Jie is showing the TA portion.
Okay, wait. Let me see my TA.
Okay.
Okay, my TA is on the previous chart lah. So the figures will be inflated lah, will be much more inflated at this juncture.
Okay.
So based on the old valuation, right, the undervalue was actually 67.32. So the initial question I was asking yesterday, I think now it comes very clear that why my fair value and old value is now so-called off the chart lah.
Yeah. Okay, because
Then,
actually, after you adjusted
yeah.
it actually goes down to $88 lah, which actually looks more reasonable lah, right?
Near at least touching the 52-week high.
Yes, correct. Yeah.
Yeah. So I applied the moving averages, right? The 20 MA is actually touching the 20 MA 79.21. Although the based on the MA moving trend, right, it's actually on the bullish trend, but it has crossed the resistance only once and come back down again. Of course, partly it was hit by what happened last Thursday lah. Yeah, so it's actually retracing down a bit, over to 76.3. I think which I'm showing the current price 76.3. It seems like the candle is quite thick. It may or may not come down to the 50 EMA support.
Okay.
So if it comes down further to the based on the old valuation, the 67.32, right, then it may be a good entry price. It may be a good entry price, but of course, if you now recalculate based on the new valuation, the current prices now are actually over lah.
Okay, so currently based on your new PE valuation, 88 is actually the overvalued price. So
okay, yes.
It's the overvalued lah. Okay, 54 is your fair value, but 54, if you take a look at your price history, just nice is actually your 200 EMA, correct?
Yes.
Yeah, so you know that 54 is a very good entry price lah, because it also coincides with a 200 EMA. Okay,
Yeah.
Undervalued is 36 lah. Okay, definitely that's undervalued because that's even way below your 200 days moving average. Okay, so personally, I feel that you definitely need to watch the $54 price. Okay, because that one was your fair value based on PE valuation and also is your 200 days EMA. Okay, I think you can also consider adding small positions at your 50 EMA lah, $72.
Okay,
Yeah.
got it.
Actually, currently at 20 EMA, if you want, you can add a very small position lah. Yeah. But 54 will be your ideal entry lah. What do you think?
54 is still a long way to go lah. It has to retrace down lah. I mean, you don't mind if I show you my thing or swim a bit?
Can, sure.
Okay, I actually wait, let me just move the chart a bit. Oh, sorry. Okay, actually the Fibo retracement is actually near the $70 mark. I think the chat is blocking, so I can't see very well.
You can check the chat lah. Yeah. Okay.
The Fibo retracement now it just crosses the $77 mark, so it's actually may possibly come down to the 72. So you are right to say that the 50 EMA entry price, right, is actually a sensible one.
Okay, and in fact, actually, if you take a look at the price pattern, this is a 1-year chart, is it? So on a 1-year chart,
1-year chart, correct.
on a 1-year chart, you can see that actually A is actually at the bottom already. So I think currently, if let's say you believe that this stock will continue to grow, you can take a small position lah. I think at the current price. Then when it really retraces based on down to your 50 EMA at 72, you can take another small position. Then if it really goes to your 54, you know that really you can allocate your full portfolio your full portfolio, which is the 7%, was it 7%? 7%, right?
Yeah, correct.
Yeah,
Yes.
Company law. Yeah.
Yeah.
You can enter in trade.
Correct. Because I can't see a very heavy possibility that it retraces down to the 68.04 line lah, because in my TOS is the SMA, the 2050 is just like crossing each other. So I need a stronger signal to determine if subsequently it will go up or come down. Okay,
can we take a look at the 5-year chart? Now you're looking at 1-year chart, right? So look at the 1-year chart. There was only once that it gave you an opportunity to enter at $68 lah. Okay, maybe we take a look at the 5-year chart and see how.
Okay, let me see if the 5-year
Okay,
chart.
bearing in mind that this company was doing very well this year, right?
Okay,
Because
let me I think show yeah, this one.
yeah, 5-year chart. Okay, so you can see that based on the 5-year chart, it tells you a very different story, right? If you look at the 5-year horizon, you can see that actually there have been multiple opportunities for you to enter actually at $66 and even below.
Correct.
Yeah.
Yep.
So actually, as value investors, right, what we really love is bad news lah about the company, because when bad news happen, we do not know when the bad news will happen, but when bad news happen, it actually helps to push the price down to our ideal entry level. So if you look at the 1-year horizon, maybe you won't have much chances to enter based on your $66 or $54. But actually, if you have a longer term horizon, like maybe 3-5 years, sometimes the bad news from the media can actually provide you with opportunities to enter at your good entry prices lah. Does it make sense?
Yes, it does.
Yeah. Okay. Yeah. Okay. Thank you so much, Junjie. Joe, anything to add?
No.
Okay. Pete, do you have anything to add, Pete? I know that you have many students asking you about this company, right? Okay.
No.
Wow. Wow. Okay. So try and catch someone. All right. Okay. So can we all thank Junjie for his very thorough analysis on MRK? Can we say thank you to Junjie? Yeah.
Okay, I will stop the sharing.
Yes, you can stop sharing. Thank you so much. Very
No
good.
problem.
Very good. Okay. Very good. Okay. So I just want to use this opportunity to share with you that actually this is how the coaching calls should be like. Okay, so if you have done your full homework before the coaching call, and when you come into the coaching call, okay, see, Brad Pitt is saying, you come into the coaching call, then it's actually, okay, you can see that the quality of the discussion will be a lot richer. And actually, Junjie and us, right, we took around 1 hour. Okay, so this is how your 1 hour coaching call should be like. It really should be how your 1 hour coaching call should be like, because you should have done your homework, come in, and then the coaches or the mentors will then value add to whatever research that you have already done. Okay, if you come inside without doing any kind of research, or you come inside taking a fish that you took from somewhere else and you come into the coaching call, it will really also affect the quality of the coaching call. Of course, Pete, please share.
Okay, hi guys, Pete again.
Hi.
Sorry, I look a bit disheveled today because I didn't do my hair, but but the thing is, I really want to thank Junjie for doing such a awesome presentation. Right, he really went through a lot of the good consideration, and the thing is this, guys, you will notice that even though the stock came from like spiking or Clement or whoever, right, but when you look at it in terms of fundamentals, then you go through technical analysis, then perhaps your investing approach may not be short term, right? Think about it. If you feel that Merck is a very good company and you think they're going to continue to produce great products, great pipeline drugs, then perhaps your investment may not be a spiking approach, right? Your investment in that sense, you might turn into a long-term approach. Okay, so it's very important when you go into the trade, also consider, right, what is the outcome you are going after, right? If the research lead you towards a more short-term trade, of course, go ahead, right? But if you research really and feel like, hey, it's a great company, I don't mind holding in the long run and I'll position size properly, then it could be a long-term solution, right? The main problem I see in a lot of students is when they look at it as a short-term trade, right? They cannot turn their brain around, right, to think of it as a long-term trade after that. They will keep thinking that, oh, I just hope that this stock will jump up and spike, then after that I will sell it, right? Like just give me this chance and I'll get out. All right, I will 知错了, that kind of thing. It's damn silly, right? It's damn silly. So you must have a game plan, otherwise you're gambling, right? So and another thing is that some of the students, when you come for coaching call, I love most of the coaching call, right? Why I say most, because some, right, it's not that I don't like the coaching call, it's that you are not maximizing to the best potential, right? What Joe Sarah mentioned. When I talk to the mentors about you guys, right, then they'll say, oh, some of the mentors ask us how to click this or that on Think or Swim. And I'm like, oh my goodness, that is not the best use of your coaching call. Oh, sorry, the mentees will say, oh, how to click this or that on the Think or Swim. Then I'm like, guys, those things, what can you do? Like, for example, you don't know how to click some parts of the Think or Swim. What can you do? Where to find idea? Where to find the solution? YouTube, right? So the thing is this, you want to ask questions and get guidance from things that you cannot Google on, right? So if things that you can Google on, right, do that so that your coaching call really, right, the max 45 minutes to an hour, right, is really damn solid discussion about the portfolio or about certain business you're looking at. Okay. Yeah. So that's all I wanted to share. Thanks very much.
Okay, thanks. Joe has something to share.
Okay, Janet was asking 1 hour for every stock, for every coaching call. Okay, of course not. Right now, we are going through every single detail. Okay, that's why it's 1 hour. Okay, you imagine this, for a coaching call, okay, you can choose not to focus on the fright because it's quite numerical. Okay, it's quite direct. It should make quite a lot of sense, you know, even when you just see the numbers. Okay, so maybe the focus will not be on your fright. Okay, maybe you may want to ask, okay, for this company, okay, another way to even maximize, whoever coach you want to book for the next session, you say, hey, so and so, I'm looking at this company, but I don't know whether it's correct or not. Can we look through together? Then maybe you can, you know, ask the coach for a favor, all right? Then maybe read through the financial statements, maybe 1 week later, discuss. Okay, that's my 2 cents.
Okay, I also want to make a further comment on what Janet said about 1 hour coaching call for just one stock. Okay, can I ask you all, right? Okay, can you all just type into the chat group, okay? What did you all learn from the Jun Jie's presentation and Joe and my response to him? What did you all learn? Can you all type in? What did you all learn from the 1 hour? Okay, I don't know why Pete is frozen here. Okay. Okay, what is died? Oh, Pete died. Okay, so how to be nimble, thought process, confirmation on understanding, thorough analysis, how to formulate your own thinking, how to be nimble. Okay, exactly. Yeah. Okay, all these things is exactly what the coaching call is for. Okay, it's actually to help you develop your own thought process. Okay, help you to become nimble as investors, help you to clarify on your own framework for investing. Okay, so this is exactly what the coaching call is for. So even though we only managed to go through one stock, okay, but when you take home this thought process, or when you take home this framework, can you apply it to other stocks? Yes or no? Can you apply the same thinking to other stocks? Yes. And through this, right, what you take away is you take away an element of how to be a better investor. Okay, so I hope that this reviewing of the homework exercise, right, has actually shown you the power of coaching calls and what it is meant to be like. Okay, so please, okay, and this was a community coaching call, yeah. And so this is also the power of, I think some of you, maybe you have attended mastermind groups where you have like community kind of sharing. Okay, so this is also the power of community kind of MMG. All right. Okay, so so thank you so much, Jun Jie. Okay, Jun Jie, your TA was okay. All right. Okay. Okay. So Felicia asked. Okay. So for Merck statement, the dividend payout is more than 100%. So this means that they actually took money from either their retained earnings or their cash lah. Okay. So you also need to ask yourself, do you think the current this kind of payout, do you think is sustainable or not? All right. Okay. So very good. I'm so glad that all of you have learned a lot from this sharing. Okay. So so please use your coaching calls well. Okay, everybody. Okay. So right now, what we're going to do is we're going to go through the next 2 segments. Okay.
The bank one.
Oh, the bank one. Okay. Sorry. Bank first, then my part. Okay. So now Joe is going to share with us additional criteria to analyze banks, because many people are asking about it.
Okay, this is the question that, the golden question that was being asked. Okay. So how do I actually look at the bank? Okay, look at the financial institution. Okay, these are the few things. Okay, you may want to jot it down. You want to take a picture, fine. Okay, although this is going to be uploaded as PDF, you don't want to log on to Facebook just to get this one slide. Okay, you can just take a picture. It's totally fine. All right. Okay, so especially for financial institutions, what they do, a lot of that, especially banks, right? They earn money by lending and borrowing money. So the first thing for a bank you must check for is this thing called net interest income. Okay, net interest income. It must be positive. Okay, if not, that means the bank is losing money. Okay. So far, okay. Okay, the second one, okay, check for bad loans. Okay, you can just Control F. Okay, do the search function on your PDF. Search for this term called NPL, or non-performing loans. This one should be 2% or less. What non-performing loans means the bank actually go and analyze all their loans. They should know that, okay, some loans some people will not return them the money. Okay, they have to be realistic. They have to face up to the reality that, okay, they are not going to get this non-performing loan back. Okay, and preferably, okay, this non-performing loan should be less than 2%, okay, of the total loans they give out. Okay, what this means is that the bank must be diligent to check the background of the person that wants to borrow money from the bank. If the bank just anyhow issue loan, this person doesn't have a job, is already $1 million in debt and still issue loans, chances are the percentage of the non-performing loan is very high. And this is not a good bank at all. All right. Okay. The third one, okay, because we know that almost every bank will have a non-performing loan, okay, to a certain extent, there will surely be people who cannot repay the loan, okay. The bank must have sufficient funds to cover all these non-performing loan, okay. So what, I hope you get what this means. It means this money is given away. They must be able to just write off, okay, cancel the loan, and then just suck it up. Okay, so what you do, you can, in your search, you can search for write-off, you can search for NPL coverage, you can search for allowance. These are the keywords you can search for. And I've done I pull out this data from DBS actually. Okay, you see, their non-performing loan for DBS is I think 1.5 or 1.8%. I cannot remember. Okay, they allow, okay, their allowance for credit, they have actually 703 million, I think. Okay, but the net loss, okay, due to net write-off for properties, other things, they are spending 26. So I would say that they are in a strong position. Even if you look at the cash flow for the year, this is still okay. They have more than enough cash to cover. Okay. So does this answer the question of, okay, how to analyze banks? Where's the chat box?
I'm the answer to all your questions.
Yeah, you can also do a fright. You can do a basic fright. Okay. Or Gordon, I'm not sharing on Visa today. Not today. Okay. Okay. Capital adequacy ratio, yes, correct. What is interest coverage is dash. Okay. Then you need to look at for all the years. Nita, which bank, which
BAC,
company?
she's looking at BAC. She
BAC,
actually asked the question just now. Yeah.
Okay. Okay, we will go through BAC.
Yeah. Okay, we will cover growth stocks in a short while. Okay, so let's just settle this.
BAC.
Yeah, BAC. Yeah.
Okay, let me see. Okay, tier 1 and tier 2, I can't remember. I read it somewhere, but now I totally forgot. Okay, you can do Investopedia. They have explanation for tier 1 and tier 2 funds. Okay, I cannot remember right now. Okay, yeah, interest coverage for BAC so far is all dash. Okay, does it mean that they have no debt? I don't know. I don't think so. Very unlikely. Let me check the financial health. Okay, 1.06. 1.06. That means their asset to liabilities is almost 1:1. All right. What else? Okay, I'll look at their book value. Okay, book value is positive. So this is weird. Okay, for all these things, if you are not too sure about the interest coverage, all right, my suggestion to you is go to their financial report. Okay, Nita, go to their financial report, check what's their latest interest coverage ratio. Okay?
Are you able to demonstrate that?
Demonstrate.
Yeah.
Let's try. BAC investor relations. Here. Let's see. SEC filings.
Okay, so we're looking for the 10K report now, right?
2020. Do they have a 10K? No.
No, don't have the 10K report.
Maybe I put 2019. Okay.
Oh, because there are multiple pages. Why don't you just type in maybe search for BAC 10K report. 10K. Yeah. I think need to. Okay.
Okay, here.
Okay, great. Okay, so we're looking at the interest coverage issue, right?
Mm.
Okay, I think this question keeps coming up, so I thought it would be good to go through it.
Interest expense.
Yeah.
Okay, 77. No, it's not this. Non-interest expense. Let's see. Interest income. Is increase and here. How come it's a change?
Total interest expense.
Wait, total, where is it?
Yep.
Is this one 6817? What is this? Let me see. Net change. I don't want to see the change. Okay.
Volume and rate. This is volume, rate, and change.
I don't want to see the change. I want to see the absolute.
You want to see the absolute amount that they
Yeah,
have,
yeah.
Okay. It is interest income, interest expense.
Let's see if they have some more.
This is in dollars. This is in dollars. Yeah, this is the one.
No, this is revenue,
Oh, revenue,
including interest.
okay.
They calculate interest expense in already. So maybe that's why even Morningstar is a dash.
Yeah.
They didn't put it in.
Yeah. A lot of non-interest expenses.
Give us some time, a few days to look at this. Okay, then we will get back to you.
Yeah.
All right. Okay, Nita.
Okay, bank's a bit tricky lah.
Yeah, it's not so straightforward for banks.
As you can tell already, it takes quite long to actually.
Yeah.
Okay, so the bank's part settled.
Okay.
Okay, you found it already, is it?
Roughly,
Okay, great.
I think it should be here. Okay, but for the year, right? Okay, for the year, okay, maybe you can use this. 103, this should be in millions. Okay, assuming this is in millions, so it's 103 million. Okay, all right. Because when you do the fried snake, the interest coverage is for every year. All right. So 103,521. Okay, what's the formula for interest coverage?
Okay, can somebody type in the value for us? 103,521. Put it in the chat box so that later on we can refer to that. So that will be the amount of interest that they have to pay for that year, lah.
Yeah.
Right? Okay. Thank you. Thanks everyone. Okay. So
let's see. How to interest coverage
Investopedia lah, right?
Okay, ratio.
A ratio, okay.
Okay. See, Investopedia already tells you.
Yes, very good.
All right. Okay. This is EBIT, earnings before income tax. Okay. Interest and taxes. All right. Interest before interest and taxes. Okay. I'll need to look for this.
EBIT lah.
Okay. To be very conservative, I'll just look for net income. Okay, although net income already puts in, okay, net income is, use this figure, let's see.
Oh, okay, very good. Wow, so fast.
Wow,
All the
wow.
figures are there. Wow.
Okay.
Okay. Interest expense is already there.
Okay. For banks, you see, it's very different. They have to pay interest on bank deposits. They have to I don't know what is other, and they have to pay interest on debt. Okay. So yeah, as you can see, right, bank is really not so direct. Okay, you really have to go to, yeah, correct. Okay, Ken, you're correct. Okay, because I don't want to spend so much time looking for EBITDA. Okay, so I will just use the net income. Okay, because net income is lower, so it's even more conservative.
Okay, see, they're all helping you already.
Wow.
See, Veronica also.
Veronica, thank you.
Veronica, yeah. So nice. Okay. Oh, wow. She even took photo for you.
How to?
Can make bigger.
Oh.
Okay. All right. Okay. Can good.
This is the change.
Oh, this is the
interest coverage. Yes.
Okay, so she managed. Okay, she managed to find the interest coverage lah. Save us all the trouble. Okay,
So as of the fourth quarter, wait let me see Oh, as of this one is 2.5.
2.5.
Okay, it's only 2.5. Okay. Wow, thank you.
Okay, thank you, community. So as you can see, right, this is the power of community. Like when we cannot find from the 10K report, then there are other avenues we can find also.
Yeah.
Okay, thank you, everyone.
Okay.
Okay, what are you trying to do?
How to go back?
Go back to where?
The meeting.
You are already in a meeting.
Oh.
So funny. Okay.
Okay.
Okay, so right, that's all for the banks?
Yep, that's all for the banks. Any other question for the banks? Any other question?
Okay, all good. Okay, I think we're all good. Okay.
Okay.
I'm thinking whether I should give them a break before the next segment.
Yep.
Okay. Okay. Okay, everybody, we are going for a 10-minute break. Okay. 10-minute break. Let me think of what I need you all to prepare before that. Okay. We're going for a 10-minute break. Okay. So when we come back, right, I would like you all to have ready the following. Have ready the following. Number one, please open up paper account for Thinkorswim. Okay. And then also please have ready your fried snake homework. Okay, that means your lunch homework lah. Okay, and if you have already, like Junjie, done out your portfolio, please have ready your portfolio. Okay, if you understand the instructions, can you please type yes? Okay, please type yes. Okay, because after this, we are really going into the strategies portion already. Okay, very good. Okay, so let's go for 10 minutes break. Okay, we will come back at 2:25 p.m. All right. Okay, let's go.